Hi everyone, so today we're going to be looking at what an auditor does and a series of videos. So before we understand what an auditor does, we have to understand a few principles. So the first one is, what does an accountant at a company actually do? Second one, we need to understand the accruals basis of accounting, which will be used by most of the entities that are audited. We need to understand the going concern assumption. We need to understand what sort of the employment cost that a company incurs, because that will influence how we test the company. And the fifth is understanding the basic taxes that a company has to comply with, that most companies have to comply with. So what do accountants working for companies actually do? Well, they have multiple roles, but at the very essence, the first one is to record transactions. Okay, and you know the transactions are recording using double entry so that the debits equal the credits. And to record a transaction, you need supporting documentation, like for expenses, invoices. For certain estimates, you need calculations. Like if you're trying to record depreciation, you obviously need to do some maths to work out what depreciation charge should be. The second step is then these transactions then make up what we call the nominal ledger. Okay, and the nominal ledger is basically a full listing of all the transactions for a given period. From an accounting system, so the transactions will normally be recorded on an accounting system for companies of all sizes. From the accounting system, you can run what is called a trial balance, and that shows the closing totals of each account, like cash, revenue, expenses for a given date. Okay, and obviously, you test that the accountant would need to check that some of the balances are correct, like cash. Is the cash balance correct? How can we compare that? Well, we can compare it to the bank statement at that given date. And then from the trial balance, the accountants will produce what are the financial statements. Okay, and the financial statements explain how the company has performed in the year, what its financial position is, what its future strategies are. So they're supposed to be used by different stakeholders to inform their decisions. Accountants also have other roles as well in the business, like they have to budget and forecast. They have to maybe conduct analysis of suppliers. They're involved in submitting tax returns and these kinds of things. They might actually themselves in the company have to calculate how much corporation tax or how much VAT is paid. Sometimes you can outsource these functions to accountancy firms. Okay, they have to pay employees, suppliers, and in small companies especially, they're the ones who are responsible for chasing customers for payment. Sometimes bigger firms have credit control departments, and the credit control departments chase the customers for payment. Okay, the next concept we need to understand is the accruals basis of accounting. And basically what this means is that we record expenses. For expenses, we record them in the period that the supplier has done the work, when we've actually received the service. Okay, so if you have a gas bill, if you've used, actually we'll go for example later on. The revenue with the accruals basis of accounting basically means that revenue is recorded in the period that we've done the work. Okay, so we record the increase in profit in the period we've done the work. As we said, for expenses, it's when the supplier has done the work. Okay, so we only record a reduction in the profit when the supplier has done the work, in the period that the supplier has done the work. Okay, and accruals basis of accounting means that for revenue and expenses, we don't care about the timing of payment and of cash payment and receipt, and you don't just look at the invoice date to determine when you should record revenue and expenses. You have to understand when has the work been undertaken. So as a result of the accruals basis of accounting, we have balances like accruals and prepayments. Okay, and I'll go through those in a separate video. Okay, We also have deferred income and accrued income. So accruals and deferred income are liabilities, whereas prepayments and accrued income are assets. Okay, but you don't need to know too much about the accounting for them yet. Let's go through some examples as to how we need to record things under the accruals basis of accounting. So imagine I get a gas bill of £10,000 on January 22, which relates to the 1st of December 21 to 31st of December 21. What period should I record the gas expense? Okay, so I'm just going to get my pointer up. When have we actually used the gas? Well, it's from 1st of December 21 to 31st of December 21. Okay, so what period does the gas bill relate to? It relates to 2021. So we record the expense in 2021. Okay, so we would do debit expense, 10k, and then credit accruals, right? 10k. So we would do this in 2021. Okay, so the next one is 2022. Sorry, the next one is when at this time I received £10,000 on November 21 to help with a building project from 1st of Jan 22 to 31st of December 22. Okay, so imagine I'm running my own business. I'm self-employed and I'm running my own business, and somebody's giving me cash to do work in the future. What period do I record the revenue this time? Well, I do record the revenue in 2022. So revenue should be recorded in 2022. And let's look at the double entries. So I'm receiving cash, so I debit cash, 10k. Where does my credit go to? It goes to an account called deferred income, because I'm delaying when I record the income. And deferred income is a balance sheet account, so we're not seeing an increase in profit of 10k. So this is 2021. But in 2022, okay, we need to record the income of, we now need to record the income of 10k when we've done the work. Okay, so we've done credit here of 10k. We need to debit deferred income of 10k. Okay, so in this way we're recording the income in 2022. Initially we credited it to deferred income in 21, but in 22 we'd actually credit now deferred income 10k. Okay. So next concept we need to understand is going concern assumption. The going concern assumption basically is the assumption that the business will continue to exist 1 year after signing off the financial statements. Okay. Now, one thing I need to understand is not 12 months after the year end. It's 1 month after the financial statements have been signed. Okay, and auditors get a bit shaky sometimes about auditing going concern, because it's quite subjective. But all the management of all companies have to do a going concern assessment. They have to assess themselves whether the going concern assumption is going to be met. And companies would normally do that. Obviously, you would be checking what the future risks of the business are and these kinds of things. So it's not, it's not as if this is a whole new thing. And lots of tools can be used to assess going concern. Cash flow forecasts. Okay, so as an auditor, you'd have to review cash flow forecasts and assess the reasonableness of these to see whether the going concern assumption is correct. The next concept that we need to understand is employment cost to a company. Okay, so employment costs there are 3 types. There's gross salary, employer NIC, and employer pensions. Okay. So gross salary is stipulated in the employment contract. I mean, there are 2 components of gross salary. There's basic salary. You might have overtime as well. and there's also the bonuses element. And the basic salary will be stipulated in the employment contract or in a salary increase letter. Okay, and bonuses, the employees might get bonus letters, or it might be approved in board minutes. Employer NIC is like a tax. National insurance contributions is like a tax. It's social security contributions that the company has to make. And as it's governed by UK tax laws, and we can actually auditors can actually recalculate the total employer NIC for all employees if they know the gross salary. Okay, so the higher the gross salary, the higher the employer NIC will generally be. And you can actually do an actual calculation. You can form an expectation, and you can actually compare to actual. And I've got many cases where my expectation has been exactly equal to my actual. Okay. The next cost to a company for employee employment is pensions. So companies have to pay pensions at a particular rate of basic salary on behalf of employees, and that goes to towards the employee's retirement pot. Okay, so it'll go to a pension provider. Now, within gross salary of a given employee, there are multiple components. Okay, so the employee won't receive all of the gross salary. He will have to pay tax on that. He'll have to pay tax. The tax will be deducted from that gross salary and employee pension contributions. Okay, so if an employee is receiving 65k per annum, if his salary is 65k per annum, the amount of money he's getting every year won't be 65k. It might be 50k, for example. Now, within gross, so the deductions that need to be made are PAYE, which is income tax. We call that income tax. Pay as you earn. Employee NIC, which is social security contributions. So it's a type of tax in a way. Any student loan repayments. There could be multiple deductions, but these are the three main ones that I've seen when I've been auditing companies. And also he'll have to pay towards his own pension. Okay, makes sense? So the net payment will normally, the company has to pay the employees, obviously. Normally companies pay employees in one go through what's called backs. So instead of paying each employee individually, they'll pay all the employees in one go. So they just press load all the payments once they're happy that payroll was correct, and then press the enter key perhaps, and then all the employees get paid. So all of these three are paid to HMRC. The deadline for PAYE is 22nd of March, 22nd of the month after generally. So for March 21, the deadline would be 22nd of April 22. Okay. That's all I wanted to say on those. But as an auditor, you want to be checking that the company is complying with tax laws. Yeah, if there's a risk that they're not. Okay, and I've never seen this happen, but there might be a risk that employees are not being paid on time, and that might indicate cash flow issues for the company. So as an auditor, you probably want to check that net payments are being made on time. Are they being made each month? Now there are additional tax. One thing I would say actually before I move on is that all the PAYE employee NIC, these are calculated by the company. Okay, so the employees don't do this themselves. The companies do this. They calculate the PAYE employee NIC and student loan, and they make the payments on behalf of the employees. So yes, there are additional taxes. So there's a tax called corporation tax, and that's on taxable profits. Okay, so the tax people are given an accounting profit, which is what you'll see in the financial statements. Profit before tax, they'll be given. and the tax people will then calculate what the taxable profit before taxes, and they'll calculate how much tax needs to be paid. Okay, and it's a separate line in the statement of profit and loss. So we need to gain, as an auditor, you'll need to gain comfort over it. Okay, and you might need tax experts to help you, especially if the company has very complicated tax affairs. Tax is a bit of a different language to audit, to accounting. It's its own language. It's like reading Chinese. In the financial statements, just to be aware of, corporation tax is confusingly called income tax. Okay, so just be aware of that. One thing you also need to be aware of is the VAT status of the company that you're auditing. So some companies may or may not need to pay VAT or submit returns. So you might want to check if they're submitting their returns on time when you're auditing the relevant company. As an auditor, you would probably need to, as we said before, consider any breaches in tax laws. Okay, so breaches, why are they an issue from an audit perspective? Well, they can lead to, there are basically two things they can lead to. So either they could be going concern issues, depending on how serious the breaches are. If they've misled HMRC, that could be a very sensitive issue. Another risk of breaches in corporation tax laws is that liabilities are understated. Okay, because as a result of breaches, the company will have to pay fines or interest on those fines, on unpaid amounts, etc. Okay. And yep, that's all I have to say, everybody. I think we'll go on to what auditors actually do each year end in the next video. Hope that was useful, and as always, please leave comments. Cheers, bye.